Hello class, before we get started, I'd like to take this moment for a bit of gratitude, appreciation. I want to shout out the gentleman that blessed us with this amazing big whiteboard. I want to give a shout out to the gentleman that blessed me with some money to buy some lighting, and the person that blessed me with some finances to get audio as well. You know, the videos that I'm making now are a lot better than the ones earlier, even when I first started. I also want to shout out all my loyal patrons that have been giving for the past 2 months now. Not one person canceled their membership, their subscription yet. In fact, most of the people that started out at a certain tier increased their amount or stayed the same and just paid the same amount. So I want to really shout you guys out as well. I want to honor you and give you a little praise as well. This is Thanksgiving week, so I just wanted to start off just like that. My name is Denzel. If you're here for the first time, welcome. At the end of this video, if you find value, please subscribe, leave a like, comment below. Let me know your thoughts, okay? So today we're going to be talking about understanding your MEC limit on your insurance policy, your insurance asset. Okay, on this channel, working with me, it's my desire and goal to help you pay off debt, increase cash flow, lower expenses, and raise your credit score, all using your own income, so that we may put ourselves in a position where we can create wealth and leave a legacy behind for our family. That tool that I like to use is life insurance as an asset on the wealth creation side and the legacy. Another vehicle I like to talk about, and a goal of mine personally, is real estate investing. That's another huge tool to create sustainable wealth and leave a legacy behind via land. Isn't that amazing? So, understanding your MEC limit, it's a vital component, a vital piece of your insurance policy. So, the terminology MEC stands for Modified Endowment Contract. Okay, it is a 7-year pay test by the IRS themselves. 7-year pay test, meaning the first 7 years of funding your policy will determine whether or not your policy will MEC out after the 40th year, the 50th year, the 60th year, towards the end. Okay, the goal is we want to have a MEC limit that has well enough space to make sure that we never MEC out. Our goal is to avoid the MEC. Okay, the IRS, after 1988, passed an act called TAMRA. It stands for Technical Miscellaneous Revenue Act of 1988. And the idea there was to limit the amount of money people were putting into these policies as tax shelters, tax advantages. So they made a restriction. Okay, the concept still works, right? It's still valid. You, as the client and the insurance agent, have to make sure that we abide by the rules properly so that we can prosper and create that wealth that we want at the limits that we want. We create that goal, that target. Okay, so a MEC is a target that you personally want to be able to hit, right? Now, another vital thing is the MEC is irrevocable, meaning if you do MEC out on your policy, that is an indication that your insurance agent did not design this properly, right? Number one. Or number two, they designed it with you maybe telling them that you want to be able to just make withdrawals after a certain time period, meaning you want to fund it for a certain period of time and then have the ability to just take money out of it and let the policy die out. That's, an option. That's not how I want my policy to be designed, or any of my clients. I want it to last the whole entire time, and then be able to pay out a large tax-free sum to your heirs. Okay? Now, MEC limit is determined by age, sex, health, and the face amount. Face amount, aka death benefit, which is the portion, the amount of money that gets paid out when the insured dies. Okay? And it is really important to really get this stuff down so that you don't make any unwise decisions. Okay? We want to avoid ill-advised decisions. Now, the MEC and the TAMRA, all by these people right here, IRS, okay? Very simple. They just want to make sure that insurance remains an asset class, not an investment. Because an investment is a taxable event, right? And that's why I say all the time, life insurance is not an investment. If it is, then it becomes taxable, then the whole thing blows up, and it's not good. Okay, we don't want that. Now, some key points is the larger the MEC limit, the bigger the death benefit, okay? Which basically means the more space that we have in our MEC limit will allow the death benefit to be that much more larger over the years, right? With the same premium amount, not changing, level premiums with an increasing death benefit over time due to the MEC. Okay? So, and then vice versa, the tighter the MEC, the smaller the death benefit. You'll have a policy that's not as flexible or as producing that it could potentially be, right? And then last but not least, cash value must never exceed the death benefit. If it does, boom, you MEC out. And then you get tax ramifications, penalties, such on and such on. Policy blows up, doesn't make sense. It ruins the concept of the infinite banking concept and velocity banking, which is the ability to, take money from this vehicle tax-free, use it tax-free, invest in it tax-free, pay debts off, right? And then the cash flow plus principal would pay yourself back, and you pay nothing to do that. All tax-free, no cost, no lost opportunity cost, no borrowing cost. That's the main goal there. So, quick video on MEC. Hope this helps. My name is Denzel. Enjoy the rest of your day, and God bless.